Welcome, everyone. Thank you for joining today's webinar. My name is Vicki Gatz, and I'm the Director of Education with AGC Michigan. AGC Michigan serves construction professionals of Michigan by fostering and strengthening the key values of skill, integrity, and responsibility of those who build Michigan. I have a few housekeeping items before we get started. All participants will be muted for the duration of the webinar. Our presenters will address questions at the end of their presentation, so please enter your questions in the Q&A box. We will be recording today's presentation and will distribute it to all individuals registered for the webinar. Today we are hosting Navigating Construction Financials During the Pandemic and Beyond, presented by Andy Rose and Tom Shemanski of Rehmann. As a leader in the Lansing office, Andy drives growth and expands service capabilities for Rehmann clients while continuing to build a corporate culture that emphasizes exceptional client service. Andy is part of the team of advisors of Rehmann's Construction Industry Group, who work with over 400 contractors throughout the Midwest and Florida. Andy serves as a thought leader and firm-wide resource on tax compliance and consulting matters and collaborates with experienced team members to serve and advise businesses and identify current and future opportunities and challenges. Tom serves clients in an advisory capacity, providing outsourced and interim CFO services, business financing solutions, turnaround management, strategic planning, system implementations, and transactional advisory services. So Tom, I'll turn it over to you to get started.
Thank you. Good afternoon, everyone. We're going to walk through a number of slides this morning. We're going to start with, let me get the slide to advance. So we're going to start by talking about navigating the Payroll Protection Program Loan Forgiveness. So we had to make some quick adjustments to this slide this morning because, as many of you probably saw, the Senate passed the PPP Flexibility Act last night, a bill that the House had put through towards the end of last week. And it really changed a number of things from our current understanding of the PPP loan forgiveness aspect and the overall program. So I thought it'd be helpful just to run through a couple of the high points of the changes that are going to be coming here shortly, as the president's expected to sign this. And then I'm sure the SBA will then move to update their loan forgiveness application and provide additional guidance based upon these changes. So just running through a couple of the major changes, the largest change is the coverage period. The coverage period has been 8 weeks from the date you got your loan funded. That's been a real pain point for a lot of Michigan companies that were shut down. I know, construction specifically didn't restart till May 7th. So, you had a lot of, employees not working, from that late March through early May time period. So if you got your PPP loan funding, let's say mid-April, you were challenged to be able to spend the required amounts in that 8-week coverage period. So they have extended that to 24 weeks, up no later than December 31st. But if you in fact did were busy during the time frame and you've already got your whole kind of process revolved around this 8-week process, there is still going to be the ability to select that initial 8-week coverage period and run through the loan forgiveness as we had previously understood it. Another big change was related to the 75-25 split. The first bill had 75% minimum for payroll cost and 25% non-payroll. So this bill brings that 75% down to 60. However, there is a slight change in the language that it does establish this all or nothing type threshold at this 60%, saying that you need to spend at least 60% to be qualified for forgiveness. I think we'll see some additional guidance on that, but that's the initial release on this change. the other, to go along with the expansion to 24 weeks, they are also extending the rehire exception deadline from June 30th to December 31st. This is probably one of the areas that has, the most vagueness to it. December 31st is a long time period. Even the 24 weeks is a long time period. So, considering the loan was only based on, two months of wages, now when you start to expand this, what is that going to do to your head count? What if business hasn't picked back up? And now you've got this longer time period to try to maintain or hit this full-time equivalent. So I think that this is probably going to be the most critical area for people to understand is how this recent bill is going to impact the full-time equivalent testing, because remember that's a direct reduction of your forgiveness. So if you can't pass that full-time equivalent test, it is going to deduct in a percentage of what you're eligible for forgiveness. So we're going to stay tuned and be pushing for clarity on how this expanded time frame is going to impact that calculation. But it might make sense if you were really geared towards June 30th and that 8-week period, and all your ducks in a row and you're maximizing your forgiveness, then you might consider just finishing it up and submitting your application based upon that 8-week window if you're already there. And the other thing they added is they expanded the full-time equivalent exemption. Prior it was you could exclude people if they quit, if they voluntarily left for like retirement, if they were fired for just cause, and you could demonstrate that you weren't able to replace them. They've now added some additional language, which is pretty interesting in of itself. But it basically says that if you weren't able to return to prior business activity, because of the related standards of sanitation, social distancing, and basically that COVID-19 impacted you to the point where you couldn't return to your prior business, that you could be exempted from that full-time equivalent test. Now that is, they wrote it in 2 or 3 sentences. That's pretty vague, and as far as what is it going to take to really qualify for that? How is it documented? So that's going to need a lot of clarification before we get a better feel for if that's an option for folks. A couple other things related. They did extend the maturity if you do have a part of your loan that's not forgiven and it's converted to a loan. A couple things have changed there. That's now a minimum of 5 years instead of 2. That does take effect now, but lenders will not be prohibited from mutually agreeing to change any notes that are in existence. So, most of you probably already have your PPP loan. Most of you already have your note. So again, if the loan is something that is of interest to you, you should be reaching back out to your lender and seeing if they will agree to extend the term if that makes sense for your business. The other thing is they're eliminating the 6-month deferral, and they're replacing it with more of a 6 to 12-month range based upon when you submit your forgiveness to the lender. So it will give you some additional deferral if you do have a loan component. And it also clarified that before you could not continue to use the CARES Act deferral of the 6.2% employer portion of Social Security, where now they cleaned that up and said basically you can use that as a deferral option for FICA if that fits your business. So a lot of fairly significant changes. Not a lot of. I think it was only 7 pages is what the amendment came out as. So I think, but it left a lot of questions. So I think this is something, if you're near the end of your 8 weeks, then you're going to have to closely look at these changes, how they impact potentially helping or hurting you from a calculation standpoint. And if they're detrimental, then you do have the option to continue to just file your application based upon the 8-week coverage period. So Just a couple other things. This is more a refresher on, some of the spend areas of the PPP program. Again, this payroll area has been reduced down to 60%. And again, salary, wages, commissions. A couple recent clarifications is that hazard pay, bonuses, commissions, those can all be included during the payroll period. You just have to stay under that 100,000 prorated amount, which for the 8 weeks was 15,385. Now on a 24-week, again, we're going to have to relook at those amounts and see what makes sense. Again, one of the more recent additions about a week ago, they added an alternative payroll period to make it a little easier. So this is only for biweekly or weekly payrolls, but if you've got a weekly payroll and you were funded on, Monday, you could wait to start your 56-day payroll period until the following Monday if that was the start of your payroll period. So then you could very easily get your 8 weeks of payroll based upon those 8 full weeks. And it allows you to even though that 8th week ends at the end of your coverage period, your alternate coverage period, you can include that even though it's paid outside the 56-day window. So they did kind of confirm that kind of accrued and paid scenario to where you can, use the alternate period to make it a little easier to calculate your payroll costs. Again, all your paid health, retirement, state, employer portions of those items. Non-payroll cost has now increased to 40%. They did again expand the definition of that mortgage interest to include real and personal property, and also rent and lease, personal property leases, so operating leases. You could include in the utilities, gas, electric, water, phone, and internet are kind of those basic things. So I'm sure many of you are already tracking. Just a couple comments on the tracking. Again, if you've got a loan over $2 million, you will have some level of review or audit. That's something they announced some time ago. So over $2 million, you can expect, someone from the Treasury or SBA to be coming in and reviewing your information. So as we talked about, how should we be tracking? How should we be segregating? I've had, some clients just said from day one, I want it in a separate account, and I'm just going to move the funds over as I fund these PPP expenses, and I kind of match that up and have that nice transactional history that I can refer to. Others didn't necessarily create a separate bank account, but just created a separate GL account in their system so they could deposit the funds and then move them out kind of as they allocated it. And I think it does a couple things. It allows you to kind of keep track of your payroll versus non-payroll, and it just gives you a running total of how that balance is running down. Other people have used projects, within their system also as a way to track PPP expenses, for aggregating. But at the end of the day, the forgiveness process is going to be governed by your lender. I mean, the SBA has released the application, which they will be updating now. But at the end of the day, your lender is going to either have, the larger banks are more likely going to have a portal or a standard template that you're going to upload. The smaller, some of the smaller banks will probably just take the application itself and just process it manually because they don't have, they don't have the volume of applications they have to work through. But I think especially with this latest release on the bill, especially if you are at the end of your 8-week period and you're considering whether you should just, apply based upon the 8-week prior definition, or whether you're going to convert to the new 24-week. I think, it's time to have conversations with your lender and really understand, how their process is going to work. How are they going to want information submitted electronically, paper? What supporting documentation are they going to want? And just get familiar with what your particular lender is going to want, because they're the ones responsible for submitting the application on your behalf. And what we've seen on the original loan application side is that, lenders, they weren't all the same. Each of them had slightly different processes. So it's just important to stay in good contact with your lenders and understand what that process is going to be. So that's a quick update just on the PPP standpoint, because I know that a lot of folks have gotten that. And you know, if you haven't, you know, there's still dollars out there. I think there's there's still a significant amount of dollars available in the program. So if you maybe looked at it initially and said, there's no way I can spend it over that 8-week period. So, you know, you maybe were thinking about the employee retention credit program or some other program. You know, this is something that now it's extended to 24 weeks. You know, as long as you get your application in by June 30th, you know, then you can set your 24-week window. So for a lot of companies that were significantly shut down and just didn't go through the exercise, you know, this clarity and the extension of time might make you reconsider and think maybe I should get an application in because I'll have a longer runway to generate forgiveness. So the next thing I wanted to kind of run through is just some cash flow modeling discussion, because I think as people are getting to the end of their PPP funding period, the use of those funds, you know, it is creating a you know, this point where people are starting to get concerned. Is like, hey, I've had my payroll covered regardless of my revenue levels, but now where's revenue going to be, and how you know, can I really keep you know, my team fully employed if revenue doesn't bounce back to certain levels? So you know, a 13-week cash flow model is you know, it's a tool that helps with visibility. You know, it forces you as a business to look out longer. You know, a lot of companies are looking 13 to 20 weeks out, and they're trying to model what their business is today and what they think it's going to be. So it is a combination of, you know, where are we at today based on, you know, our agings and our open sales book backlog, but then it also forces us to look to the future. You know, what's our current project? You know, how's it gonna flow out from a cash flow standpoint? And what do we think our conversion rate is in our pipeline? Which deals do we expect to close, you know, that are gonna generate cash in August, September, you know, October? And it really drives two things across your management teams. It's engagement, because you're getting different departments involved, you know, from your finance into your sales, purchasing, your production scheduling, your contract management folks. And then it's focus. It's as your team kind of develops their plan, it gives you a good point of reference to keep your team focused and really on what the key priorities are, from contract management to expense management to labor management. So it really tries to get everyone on the same page. So an effective 13-week cash flow model, you know, it's not a traditional cash flow statement. You know, if you think about an income statement, a balance sheet, and a statement of cash flow, I mean, that's just a measurement of time. End of the month, where were we? You know, a 13-week cash flow is much more dynamic. It's customized to your industry, and it's really helping you identify where are my low points from a working capital standpoint. You know, am I dropping to where I'm going to have to tap my line of credit? You know, I mean, is my line of credit, if I'm already using it, you know, where do I start to get where it's, you know, out of my comfort for remaining availability? So that's what the 13-week model really does for you. It's kind of combining what we know today from our AR and AP and what we're forecasting, and then we're just maintaining it on a rolling forward basis to really understand, you know, especially as we ramp back up. You know, if I've got large, you know, material buys I need, if I've got, you know, large amount of WIP labor that I need to put into a job before my next billing milestone, and then I need to wait to be paid, you know, for my customer, how's all the timing of this working in this time where we're ramping back up from limited production, you know, limited activity to very busy again. So if you don't have a 13-week, you know, model, that's definitely a tool you should take a closer look at. And it really allows you then to build in, you know, kind of some of that uniqueness to your business. You know, whether it's you know, if you've got labor-intensive projects, if you've got you know, some equipment, right? You take on a project, but you need some new equipment to support it. So you need to plan some fixed asset purchases. You know, and especially on the construction side, you know, those time lags between, you know, billings and collections and and really understanding where your cash flow is also is going to help you on the front end of negotiating your contracts, because if you know cash flow is tight, then sometimes you're just going to have to pass on those projects that have where they're pushing the burden of cash flow onto you, and you're going to need to look for more deals that are a little more cash flow friendly with better deposits and better progressive payments throughout the project. So those are all things that you need to kind of understand, and don't lose track of things like tax payments and distributions that are needed for the business. So it's really kind of a centralized tool to kind of understand what your cash flow looks like, your line of credit availability looks like over the next 13 to 20 weeks, and really put you in a position to make good business decisions and give you peace of mind. I work with a lot of business owners, and I would say on our fractional CFO type projects, cash flow management, almost every deal we do has some form of a 13-week cash flow, because leadership and ownership want peace of mind that they've got a pretty good handle on cash and where they're heading and what the impact is of either taking or passing on certain large projects. So all things that can be worked into a 13-week model to give you a business tool to help drive your business forward. All right, that's kind of what I have from my side. We're going to pass it over to Andy, who's going to talk a little bit ratio and benchmarking for your industry.
Thank you, Tom. And Tom's group, I've been on enough calls and worked with Tom enough to know that he and his team are not, outsourcing is not the word we like to use. It's supplementing your existing finance department. So Tom and his team are very helpful in terms of coming in and adding more bandwidth to your finance team. Maybe you've already got a CFO in place, but your CFO's plate runneth over. And so, Tom and his team can come in and be project oriented, facing things that projects that have not been able to fit into the daily task list of your existing finance team. So they do a great job. So Tom, thanks for that. One question I have for you is, and I think this question comes up common, is, I've never started a cash flow forecast before. So how do I even start? Any tips for someone that's in that situation that just doesn't know where to begin?
Yeah, I think it's just collecting all your source data, your payables, receivable agings, your sales pipeline, and really we have all levels of, kind of spreadsheet-based tools that we use, things that are very simple, sources of cash in, sources of cash out, to multi-tab, more sophisticated, sales pipeline tracking, significant purchase tracking, and forecasting, production and things like that. So the good place to start is just a real simple listing of projected, cash inflows, projected cash outflows, and probably on the construction side, you're going to make that more project oriented. You're going to really try to line up, hey, here's my $300,000 project, here's my expected, progressive payments, and here's how, I know that I'm going to need to bring in all this material 2 weeks before I can get to the point of doing my first billing. So you kind of just layer in your timing based upon your project timing, and that's a good start. Just to get some things laid out, and but that's that's what we, with our clients, that's what we focus on, is really developing that full cash conversion cycle, and then layering in some things to plan for other things such as equipment or distributions, and just to get a kind of a full snapshot.
Great, I appreciate it. Thank you. All right, ratio analysis and benchmarking. So let me grab control of this here. All right, so this happens to be an Excel spreadsheet that I work with, and so I've had to figure out a way to get this onto a PowerPoint presentation so that everyone can kind of follow along. But I'll be, because it's back and forth between a few tabs in the Excel spreadsheet, I'll be looking at the Excel document while you're looking at the PowerPoint. So It's not that I'm not paying attention. It's just my dual screens will be taking some of my attention. So we're actually going to focus, I guess getting started, benchmarking and ratio analysis. I mean, some people might think, man, it's kind of an odd time to be talking about benchmarking my company and looking at ratios, but this is probably a opportune time to be doing that, considering what's going on out there in the environment and the fact that operations just got started about a month ago after being shut down for a month and a half or more. So during that period of time, most likely you've depleted some cash reserve, taken on more leverage. Receivables may be getting a little bit dated as everyone holds on to cash. So and ultimately, if you do have debt on your books, then most likely you've got some covenants. And so if nothing else, making sure that you're keeping track of those covenants that are tied to your line of credit or equipment financing or whatever the debt might be comprised of. Um, ratio analysis, I mean, there could be a couple reasons why you're doing it. You could be comparing year over year, which is pretty common to do. Where do I stand this year with some of my key performance indicators versus last year? But today we're going to be focused more on the benchmarking aspect of looking at these ratios or KPIs. And so comparing them to some industry information that we've got out there, some data, and primarily I'll be pulling, not primarily, I'm pulling data from RMA, Risk Management Association, which gives us a lot of great benchmarking data. And then also, CFMA, so I'll do a shameless plug for the Construction Finance Management Association, which I happen to be president of the Lansing chapter right now. So CFMA, if you're not aware, has got some great benchmarking that they do on an annual basis. And I think last year something like, 1,500 companies across the country took a financial survey, and all that data is available. And it's some great benchmarking data that's broken up by region, by your trade. So if you happen to be specialty trade, it's by size. So maybe I want to see where I line up with another company that's I'm 10 million. Maybe I want to see what some other companies that are around that level of revenue are, what their key ratios are. So it's some really good data, and it allows you to stratify it and really kind of see where you fit, against others, your peers. So I am actually going to fast forward this to this page. So this is a tool that I use. I use a couple tools. CFMA happens to, you actually have the ability to run your financials through their benchmarker and get a pretty great report out of it. But I use, this is just a 4-page spreadsheet that I use internally that I've kind of tweaked and added some things along the way. And so, one thing too, in terms of KPIs, I mean, there are an awful lot of key performance indicators or ratios, whatever you want to call them, that are out there. I mean, there's, I simply don't have all of them on this tool that I use. I've got some very common ones, but I think it's important to mention that, whatever your goals are or your strategies in your company are going to drive the metrics that you're going to want to look at and pay attention to. So for example, maybe our goal is to increase our liquidity in my company. And so, I'm going to focus on some of those metrics in my ratio analysis and my benchmarking that, measure liquidity. And so there's certainly plenty of them out there that do that. I've got a couple on here: the current ratio, which I'm sure most people have heard of, and the quick ratio. which is commonly referred to as the acid test. And so I'm going to walk through some of these, but by no means are we going to get through this whole template that I have, this diagnostic tool. But my goal is to just at least get you comfortable and familiar with using a tool like this, and seeing where you stand again against your peers. So we're going to start out with working capital, which is the very first figure you'll see on my spreadsheet. Get back to that. So working capital is simply, it's your current assets minus your current liabilities. And it doesn't get much easier than that when we start looking at these ratios. And so in my particular circumstance, you'll see that my current working capital is that 868,188 number. And so one of the other things that I'm always looking at is, where does that number stand in terms of my revenue? And so that's another key performance indicator that I'd be looking at when I'm putting together this analysis. And so that's what that 13% represents. So that working capital is 13% of my annual revenue. And so this working capital number will, it'll come in to play in both working capital terms, and it comes into play in some of my others. So it's a pretty key figure that that gets used throughout this. So again, moving on to working capital terms. So this would generally, it's looking at how much my working capital is generating in revenue. So dollar for dollar. So in this particular circumstance, I am taking revenue and I'm dividing it by my working capital. And so the numbers in blue represent my actual numbers, and I'm comparing them to the data across the right. So, and I should point out this too, that my numbers that you'll see, industry worst, industry median, industry best, that's RMA data, and that is by NAICS. So that is 238, 210, which for those of you out there that happen to be electrical contractors, you'll know what that NAICS code is. So it's important to make sure that you're pulling the data for your particular trade too, which in my case, I'm using an example for an electrical contractor. So I have 7.7. And you'll see that, moving across the right, again, that puts me somewhere in line based on RMA. It puts me towards the median. But if I look at my CFMA data, which is, this happens to be a between $2 and $10 million electrical contractor. So I pulled that data from CFMA. That puts me at, it's not terrible. Again, getting back to liquidity, if one of my goals is to increase the liquidity in my company, an increase of cash on hand would certainly do well for this ratio that I'm looking at, and it would probably, move me maybe a little bit closer to my numbers there in the industry best of 5.0, or even the CFMA of 6.1. So, obviously playing with these ratios is helpful, so I can start to kind of model some numbers and see what it does to these ratios, and see what I need to do to get those ratios to move in the direction that I want them to move in. And so it's important to understand that as well. So, you may want to create a separate spreadsheet where you're modeling out certain directions you want to go, which will ultimately drive behaviors. So if the goal is to increase liquidity, then that needs to drive other behaviors in terms of maybe taking out too much compensation, or paying payables too fast, which we'll get to. So the current ratio is, again, current assets minus current liabilities. So that's, again, it's a pretty easy one, and you'll see that we're at 2.2. And I've just placed some notes, as you can see next to it. It puts me pretty close in line with the CFMA data. And so if I look at industry best from RMA, it's not terrible. You know, I'd be mostly okay with where I'm falling on that number. So quick ratio, again, I talked about that before. That's the acid test. So that is taking it's really anything that you can convert to cash within 90 days and then subtracting out your current liabilities. So if I had to generate cash immediately, what would I need? What would I get? So obviously cash and cash equivalents are in that number. Your short-term investments are included in there. Things like inventory, even accounts receivable. Well, your current accounts receivable, usually you back out anything that's your old receivables. So you'd factor in your current receivables, but things like inventory get excluded from that. And then compare it again to your current liabilities. So you'll see that in my particular situation here, I'm at 1.5 and probably a little low. I'd like to have a stronger cash position. So again, we kind of go back to liquidity here. And so, you know, a strengthening of the amount of my cash on hand or short-term investments, or maybe even, you know, again, I'll get to this one too, it's coming up, but maybe being, you know, collecting on my receivables a little quicker, and I can bump up some of these numbers, some of these ratios, and get them closer to being industry best, or you know, maybe higher than where they're at right now. Debt to equity, again, there's a pretty common one. So just comparing, you know, your total liabilities with your total net worth, and that puts me at 0.9, which industry best is 0.6, but CFMA is 0.7. So I would say it's not terrible. It's a little on the high end, but it's certainly not out of line. I mean, obviously you look across there, and once you get to the median and the industry worst, I mean, the numbers are pretty high. So AR turnover. So how quickly are we collecting once we send out invoices? This is a good one to be looking at, especially right now when everybody's holding on to their cash. So we are currently at 60. And the CFMA standard is 58.5, so we're not terrible. But the industry best on RMA is 48. That's a fairly sizable difference, delta between the two. So one thing that I would note here is that typically when you're looking at this, you are subtracting your retainage. I did not pull out retainage for this. My retainage is pretty insignificant. So so it's in there. And would it move the dial much? Maybe it gets me to the 58.5, but it's not going to get me anywhere near the 48. So my note here is, what can we do differently with accounts receivable? Can we be more aggressive? Are we reaching out on older ARs? You know, what can I do differently to, again, drive a different result and ultimately improve my cash position? AP turnover, just, you know, opposite of AR. How quickly am I paying my vendors? And so in this particular case, I would say we have an ability here to, again, obviously you've got your subcontractors and your vendors that you want to take care of. I mean, you don't want to push them off forever because you need them. But I think in our particular instance here, I think we are probably paying pretty quick. And so we're at 16 days, and CFMA is at 20. And actually industry best is at 16. But I think there's a little bit of room there to maybe slow down the payments on our AP. And again, drive the behavior and the goal that I'm trying to do, which is increase my cash position. Return on equity. This is another one that I would look at, and this is going to be your earnings before interest and taxes divided by total net worth. So I'm going to take my net income over on, I should have started over here. So I will show you this right now. So the first place I start with this is I'm taking the balance sheet and the income statement, and I'm dropping in all my numbers. This is the engine of my analysis. So then I've got the liabilities and equity. So, right now I'm looking at total equity, which is 993, 991 in my example. So my return on equity, I'm taking earnings before interest and taxes and comparing it to the total equity in this company. And then I've got my income statement. And you can see, I don't break out a whole lot of stuff. I primarily go with the higher level. I could really do anything with this. I could start to really get down into the weeds on certain expenses and start doing some analysis on individual line items, but I keep this pretty high level. You'll see this number too over on the ratio page, this 25.27. So this is my gross profit. And really for this particular electrical contractor, that doesn't move a whole lot. I would say in any given year, we're at 24 to 26%. So it's right where it should be, or where it not necessarily should be, but usually is. We all like to increase that gross profit percentage as much as possible. So in this particular case, again, I took my EBIT and divided that by my total net worth in this company. And I'm at 8.52%. And as you can see, CFMA, and this data does, this particular ratio does not a factor in the RMA, so I don't have anything there. So I'm looking at CFMA and it's 19.4. So I got a significant difference, but this happens to be a C Corp and we manage the amount of income that's left in this company. So when I look at that, I would guess that the fact that we're doing some large owner compensation driven on performance or bonuses at the end of the year, I would probably guess that that's driving that difference, that delta. So obviously some of it could be profitability, and maybe there's some room for improvement in especially SG&A. But I would believe that in my case that I am artificially driving that return on equity down by bleeding out the income on an annual basis. I don't have significant bonding requirements here, so I don't have a surety that I really need to leave a whole lot of net income in to build up this surplus of equity in this company. So we leave a little bit in each year and we take the rest out. Gross profit percentage, again, that number came from the page over, that was 25.27. As you can see, I'm fairly in line with the industry best, and actually that's in the wrong column. That should be over in the CFMA column. Like those got moved over. So, but as you can see, in comparison with CFMA for a $2 to $10 million company, we're right in line with where we need to be from a gross profit percentage. General administrative expenses, I'm at 24.08. And again, that's CFMA data, but that's 21.7. So I go back up to what I just mentioned about owner compensation when it comes to return on equity and the fact that I have a pretty sizable delta there. Then I look at my general and administrative expenses, and I'm high, so I probably have some ability to maybe trim some expenses or look at some areas where maybe we're paying more than we need to, or some costs could be reduced. So if I come down to operating profit, mine in my example is 1.19%. And obviously, if gross profit, or if gross profit's about the same, but general and administrative from a CFMA perspective is less, that means we're going to have more at the bottom line, and we do. So 3.9 versus 1.19. But again, I think that probably in my case, I think some of that again could be, the owner compensation pool and the bonuses that get paid out. So, in really, managing that bottom line. Another comment, I want to make sure I'm leaving enough time for some questions at the end, but another common, I would say, test that we're looking at, and a lot of times I'm looking at this for if I've got a general contractor that's qualifying their subcontractors, we're going to run some type. I've actually used this diagnostic tool to do exactly that, which is to just make sure that our subcontractors that we're doing business with are strong enough and have the wherewithal to complete jobs without running out of cash. So this ZScore is a combination of a number of different ratios, and some of them are. Just take you to this page if I can get there here. Okay, we're going in the right direction. All right, so this is one of them. So Z-score is, and I've seen it calculated differently, but I mean generally it's pretty similar. But in this particular one, I'm looking at return on total assets, and you'll see that you've got the formula there. So we're taking EBIT divided by total assets. There's different weight factors that are applied. This is like, I think it's referred to as the Altman Z-score, and I mean this is an there's a lot of algorithms and a lot of math behind how they come up with these weight factors. If you want to read about it, I'm sure there's an article somewhere out there on the internet on it. But I mean, I primarily look at the figures that are generating my end result, which is my my Z-score factor. So this particular one is weighting it 3.3 times. So we come out with a weighted ratio on this. And this one is assessing the ability of a company to effectively use its available assets to generate earnings. So this is the first one that I'm looking at. The next one I'm looking at is sales to total assets. You can see the weight factor is a little bit lower on this one. And with this one, we're looking at the ability of a business to generate sales on a small base of assets. So this is an efficiency ratio. So how much revenue can I generate using as small of a bucket of assets as possible? So this one is also part of the Z-score. Equity to debt, again, got a weight factor here. This is looking at evaluating how much leverage a company is using. Working capital to total assets. So again, we're looking at working capital, which is, as I said before, a very important number to be looking at. So this one right here is a measure of liquidity and assesses ability to cover short-term obligations with remaining liquid assets. And then total net worth to total assets. So a measure of your capital strength. And this one, of course, got a little bit different weight factor. So all this gets baked into the recipe. And we come down to a Z-score of, that's not right. Not 0.74. Obviously, trying to get an Excel spreadsheet into PowerPoint is proven to be it's actually 5.689, which is good. If it was 0.74, we'd have a problem here because, as you can see, generally speaking, the industry standard is that anything below 2.675 indicates failure. So had that been 0.74, I might not be working with this client anymore. So I'm pleased that it's 5.689. So moving in, so that's meant to be just another, as you're looking at the financials and you're measuring the strength, it's just another KPI that you're looking at that has the ability to show whether a company is nearing bankruptcy is really what you're looking at. So as that number trails lower, that means there's more stress and more opportunity for, again, failure. These are just some some numbers that I keep handy. I'll sometimes be looking at these when I'm looking at leverage ratios. So I happen to know that they have a total line of credit. It maxes out at 750, and at year end they were at about, I think that works out to about 40%. And then knowing when they're coming up on renewal. Again, as you can see, and I'll just kind of wrap this up here pretty quick, just in case we got questions. And as you can see, I've got an aggregate limit from a bonding perspective of 4 million with a single project limit of 2 million. Again, I don't have this particular contractor does not have extensive needs for bonding. And so you can see that we were way under our aggregate limit of 4 million at the end of 2019. And that's that number obviously fluctuates, but I don't recall a time where we've been close to the aggregate limit. Backlog. So we're looking at backlog. We're looking at it's important, obviously, very important, but I'm usually looking at how much backlog and what does that mean in terms of months. And so in this particular case, the amount of backlog was pretty low at year end. I got 2 months essentially of backlog, and that just means that with that current load, with that current amount of revenue sitting there that has not started yet, it's only going to take me into the following year by about 2 months. So it's pretty low. Generally, you want to have about 12 months of backlog of work that's been awarded that you have not started yet or not commenced on. Gross profit in the backlog, it's a pretty easy measure. It's just taking my gross profit, which you saw over on the other page at 25%, and applying that to my backlog. Also tracking EMR on this particular diagnostic tool. And so we've had a couple tough years. We've had some accidents that have driven that up. As you can see, we're not trending in the right direction for the EMR. So anything over 1 is usually kind of a concern. Once you start getting over that, those out there, the sureties and the others that are looking at your financial statements start to take notice. There was a couple. So that's about all I wanted to go over. I mean, there's a few things more that I could mention, but I want to make sure again that we're leaving time for questions. Vicky, do we have any, or Sam, Kalen, is there any questions?
We don't have any at this time, but if anybody wants to reach out with questions, we feel free to.
I will mention that I don't think it's on this PowerPoint, but one other thing that I'm looking at, and I don't, for some reason it didn't make it on here, usually looking at my underbillings too. So, oh good, we're on the right section here. So underbillings at this point in time at the end of 2019 were 20,852. So they're not substantial. I'm sorry, that's my that's the wrong number. How do I, okay, wait, I need to get to my assets. Okay, there we go. All right, my underbillings are 181,640. And so one of the other things that I'm tending to look at too is what does that compare to my working capital? Because ultimately my underbillings are being financed by my working capital. And so kind of the measure, if you will, of what should that number be at? That number would tend to be 25% or less of your working capital. And so in this particular circumstance, if I take my underbillings and I compare it to my working capital, I'm at 21%. So I'm not over the 25, but it's not terrible, but it's something that I want to keep an eye on. So obviously, you all know what underbillings represent. It means that I've got costs that I have not been reimbursed for. And so that's usually something that, your surety companies or your sureties and your bankers are looking at to make sure that you don't have excessive underbillings, because that could generate, that could be the result of unapproved change orders. I don't have it on here either, and typically I do it on a, I would take like my work, my completed work schedule. But another thing that I'm usually looking at is what's called profit fade. Any more than 10%, 10% is kind of the standard. So when we went into the project, I was expected to generate, X amount of profit, and when the project ended, it was less. And what was it less by? So we're starting to, or not starting, we're looking at how much profit fade there has been, and even, in certain cases, if it's significant enough, maybe performing a postmortem. Why did it come so far under what our estimates were? Obviously trying to look and learn lessons and for future projects. I don't think this was on here either, but one of the other things that I'm looking at too is where are we at from a bonding rate perspective? I think it appears on the key. So if I go back to, should be somewhere on here. There it is. Okay, so the bonding. So what's my rate? What's my current bonding rate? And generally you're somewhere in the 1.5, 1 to 3, I'd say. So keeping an eye on that too. I've had certain circumstances where maybe I've got somebody that's doing a compilation, or they're engaging us for a compilation of their financial statements, and let's say they're at 2.5. In other words, 25 basis points per $1,000 of bonding that they're requesting, and we've moved up to a review because the surety is has indicated to us that our rate will be reduced if there's an increase in the level of assurance. So I've seen that have considerable impact on the profitability of the company too. So maybe you're at 2.5 or 3 with a comp, and you go to a review and it drops to 1.5, and maybe on one bond it's not a big enough difference to generate the or to pay for the difference between a comp and review. But if it happens to be a year where you've got you're going to have a significant number of bonded jobs, it might be something that you'd want to inquire in to see what that would that difference in assurance would generate in terms of savings. Well, I take that back. I pretty much got through really what I wanted to get through. So I didn't realize I would get through all that. So that's good. And we ended up getting. I was talking to Vicky before this thing started. Everybody got some bonus content today, and with the passage of the PPP rule or changes late yesterday afternoon, everyone got some insight into what that means. So that was great that Tom was able to cover that. So I have nothing else. Vicky, Tom, I don't know if you have anything else, but if not, and there's no questions, I would say we landed this plane in on time.
All right. Well, thank you again for joining us. If you have any questions that come up, you can reach out to us via the Rehmann website, and access to the slides as well as the recording you can find at rehmann.com/COVID-19. Thank you and have a great day.